Good afternoon, everyone. I'm happy to welcome you to Bridge to India's webinar. Our topic for the day is an interesting one indeed. It is trying to make sense of the 2 rupees solar tariff. We have a diverse panel today to discuss this topic, and we welcome you all once again to it. This is Sangeeta Suresh, and I'm pleased to introduce our panelists to you today. We have Mr. Sanjay Varghese, President and Head of the Solar Division from Renew, bringing in the perspectives of the developers. Also with us today is Mr. Sanjay Kumar, Head of Business Development from L&T, and he's representing the EPC players' point of view today. From the equipment suppliers' point of view, we have Mr. Lim Boon, Head of Product and Marketing for the APAC region from Trina Solar, and Mr. Andrew Gilhooly, the APAC Head of Trina Pro, which is Trina Solar's tracker arm. We welcome you all today. We also have Mr. Hani Raza, Head of Sales at Ginlong Solis, and he will bring us the views of the inverter suppliers. And finally, we have Ms. Zia Nariman, Senior Investment Officer from IFC, and she will talk to us from the finance angle. Welcome all of you, and thank you very much for setting your time aside to join us today. We would really like to thank our sponsors, Trina Solar and Ginlong Solis, for extending the support for our webinar initiatives and helping us to bring great content for free to our audience. So now on to the agenda for today's webinar. We will begin with an introduction on India's renewable tariffs and bidding trends and where they stand today. Mr. Vinay Rustagi, Managing Director, Bridge to India, will set the stage for the discussion, and then we will immediately jump into the panel discussion as we have a lot to talk about today. We will have a Q&A session after the panel discussion, but the participants can send in your questions at any time through the text box located at the bottom right corner of your webinar panel. Do mention which one of the panelists your questions are directed at so we could organize the questions in order. As always, we have an audience poll during the webinar, and we have a few feedback questions at the end as well. I request you all to send in your responses because that helps us to curate future webinar content better. Before handing over to Vinay, I would like to highlight our flagship product, the India RE Navigator. It is a market intelligence portal which provides you with easy to access, round the clock and fully updated information on all aspects of India's renewable energy sector. For more information about our product, please visit www.renavigator.com or write to us at contact@bridge2india. Now over to Vinay. Over to you, Vinay.
Yeah, thank you, Sangeeta, and welcome again to all the panelists as well as all the participants in the webinar. So, like Sangeeta said, the topic for the webinar is trying to understand what's happened in the Indian solar market in the last couple of months when tariffs fell down to 2 rupees. And here is a chart of all the auctions in 2020. And I think it's very interesting. Back in 2019, there were many tenders which were undersubscribed. In fact, almost every second tender in 2019 was undersubscribed. And then in 2020, after the government removed the ceiling tariffs, the module prices came down a little bit. I think there was more stability. We started seeing more activity in the auctions market. And then, as you can see in this chart, there was a pretty stable range of around 235 to 250 across the year for various auctions. But then suddenly we saw in the last 2 auctions, tariffs fell down pretty sharply to 2 rupees and 199. And the objective of the webinar really is to kind of try to dissect and discern what are the various factors which have contributed to such fall in tariffs. There could be a whole host of factors, technical, financial, market related, etc. So we've got this panel who will help us understand the key trends. The other thing, obviously, is that not all these tenders are similar. Every tender has some unique aspects in terms of the size, project size, structure of the tender, offtake risk, etc. And hence, we just really need to understand why did the tariffs fall in these 2 tenders, and who put the tariffs? What does it mean for the future trajectory of tenders? Now, I was looking at some data actually yesterday. In the last 5 years, starting January 2016, cost of modules actually fell by 50% on a CIF basis. So without any taxes and duties, the cost of modules fell by 50%. The total EPC cost, including GST, duties, etc., fell by 43%. But tariffs, they actually fell by 58%. So clearly the tariffs have fallen by much sharper than the cost. Now, is that because of some changes in financing parameters, or is there reduced finance expectations, etc.? That is something which we will discuss during the webinar. Let's move on, Sangeeta. Just quickly, before we get into the discussion, here is a list of all the participants in these two tenders. Basically, we have shown the bid capacities on the x-axis and the tariffs on the y-axis. And we've just taken a very crude attempt in trying to segment different developers. And to our mind, basically the winning developers comprise a mix of either new people, new developers like Al Jumaia, keen to make an entry into the sector. There are developers like Solar Arise and Semcop, which have not really been very active in the last few years. So they're keen to build up a pipeline. And then there are, of course, the public sector companies, NTPC and SJVN, a huge financing and scale advantage, and as well as very large targets to turn the business model and shift towards renewables. So there is really no one trend that I can see. The motivations of different developers seem to be quite different in terms of their own bidding behavior and expectations from the sector. So let's look at, during the webinar, we'll look at the market scenario, we'll look at the various technologies, trying to understand really in great detail and as granularly as possible, what are the various factors which have contributed to the fall in tariffs. We'll look at the changes in O&M, asset management practices, and finally, Zia will talk to us about bankability and financing. Let me now turn to our panelists. I will start with Sanjay Varghese at Renew. Sanjay, you probably have the best ringside view on the sector. You're obviously one of the biggest developers, very active participant in these auctions, although not on these two auctions per se. So just try and explain to us or help us understand what is your reasoning and theory why tariffs have fallen down, and what does it mean for the solar or the renewable market in the whole? So let's start with that, and then we'll go deeper down into various factors.
Thanks, Vinay, and good afternoon, everyone. So you already touched on some of the points that I could have spoken about. But basically, if you have to understand these bids, there are four major factors that I can think about. One is about supply. So there were no large bids which had come out about 6 months before, in the 6-month period before these two bids, right? Probably because of COVID, things had slowed down at SECI, NTPC, and HPC end, and also probably because of the backlog on-site PPAs that SECI had. So these two bids, one was almost 100 megawatt, the other was 500 megawatt. They were the largest bids which were in the 6-month period. So supply was low. The biggest issue was demand. As you already mentioned, there are many new players who came into the market. And there was also the factor that, the PSUs have come in strongly. And what we have seen in the recent past is there's a large amount of capital which is flowing into the market. So it's not just new players who come in, it's also the older players who have no new capital allocations. So that led to an increase in demand. And what was unique about these two bids was, unlike the ISTS bids, there was certainty about evacuation and PPA. So typically the SECI ISTS bids, you are bidding to connect to the PGCL network, which is under construction. These were, state-specific bids. So the evacuation was certain, and also the PPA offtake was also certain, because either Gujarat or Rajasthan was to offtake the power. So this was the attractive factor, and that coupled with the capital situation basically meant that the demand was very high. Third factor, of course, for the drop in tariffs would be the low cost of capital. Now, you talked about how the PSUs are able to raise money at low rates. But across the sector, I think what we see is interest rates have come down post-COVID. So some people would have baked in that benefit into the calculations. And also what we are hearing is that, people have become more aggressive about their INR expectations. So even the equity IRRs which are being, which people are bidding with, I believe those numbers have come down. So this is one probably the biggest factor. Plus the fact that the rupee has sort of stabilized, the outlook looks strong. So typically people tend to build in hedging costs into their future module procurement, etc. So maybe some aggressive assumptions have been taken on that side. So these are three big factors. The fourth factor that we hear about from the industry is that there may have been slightly aggressive assumptions on the cost side, which maybe slightly risky because if you see the current situation, all the commodity prices are at almost 2 or 3 year peak. Module prices have gone up substantially over the last 4 to 5 months. In fact, we are seeing at least a 10 to 15% increase across both modules and BOS. So considering that, but still, I guess people take a positive view and expect things to stabilize by the time they have to execute these projects, which is the end of 2022. So those aggressive cost assumptions could be a factor, and we are also hearing there might be some aggressive assumptions on the technology side, like people considering bifacial plus stackers. I believe few of the players have considered that and taken some aggressive assumptions that maybe people like us are not very comfortable with on the generation gain that you would get out of bifacial plus stacker. So it's all these factors combined together. I think it's probably led to the tariffs that we're seeing. Overall, I would say it's actually great for the industry because it opens up a lot of avenues. Solar is suddenly more competitive, probably competitive even with pitted coal plants now, right? And with a little bit of drop in storage prices, solar or hybrid plus storage as baseload power is not too far away. So positive for the industry, but probably a bit earlier than what we expected. Yeah.
Vinay, you're on mute.
Vinay, can't you?
Yes, sorry. So Sanjay, you talked about various factors. I think that makes a lot of sense. If you were participating in these tenders, that's an if. Where would you see the balanced tariff, balanced case tariff, just to try to get a sense of how aggressive these tariffs were? Was 236 the tariff before these auctions the right level? Was it a little bit plus minus?
I mean, little bit minus because of the lower interest rates,
Right.
but not to these levels. That's what I would say. Yeah.
Sure. Okay. Thank you, Sanjay. So I think one of the key things Sanjay mentioned was what the developers are assuming on possibly component costs, technology costs, as well as power yield assumptions. So I think that is a pretty relevant point to come to you, Lim. And there is a lot of buzz in the Indian market about improvements in module technologies, larger modules, more efficient modules, bifacial technologies, etc. How real is it? Are you finding that the Indian developers are beginning to deploy bifacial and some of these other more efficient modules in big numbers? Have these installations moved from pilot stages to kind of main project level installations? And but Sanjay also mentioned about aggressive cost assumptions. So if you can throw more light into what are the various technology considerations when bidding for these projects in the current times, and what are the various LCOE or the other cost benefits because of these new technologies?
Yeah, thank you for the question. So I think from the module perspective, we are very excited that we have all these new high power bin modules that is coming into the market. And if you look at overall in terms of the whole project on a project basis, on a system cost basis, I mean we are quite positive and quite certain that using higher power modules is able to help our customers, the developers or the project owners to get a better costing in terms of the overall system level. So which is why we do see the trend that all the different module manufacturers are in sort of a race that is going forward to try to launch these higher power beam modules to the market. And we are actively promoting that, and we do see that there's more and more take up from the different customers, and they might after doing their own simulation, I think they will also start to recognize that how these higher power modules can help them to save in terms of the project cost. And at the same time, I think one interesting factor that we look at, previously before the COVID, everything is like very normal. We can go with the normal labor, normal land usage and everything, and all the components is all flowing very freely. But after this COVID happened, so actually we do see some impact. I mean, not only to the solar industry, but also to the overall, the global impact. So one point interestingly we can see is that labor cost is one factor that has started to increase because of the movement of people getting restricted and all this. So labor cost becomes the issue when we're deploying this kind of a large scale solar. So one perspective that we can look at is maybe that if we're using higher power modules, we install less numbers. So actually the overall installation and the labor cost might be also reduced from this aspect. Then another point on the bifacial, I think the bifacial has been around actually for a very, very long time. They have started to pick up probably about 2 to 3 years back. So I think until now there is already a lot of data, a lot of projects that has already deployed the bifacial module, and overall we do see some very positive feedback and power generation from all the different bifacial projects. So going forward, definitely I believe for the Indian market, the India developers, they will also start to deploy all these bifacial module, further enhance their project yield and to achieve the lower LCOE for this lower tariff era. Yeah, thank you.
Lim, if you don't mind, I'm just going to push you a little. So you've talked about savings in land cost, POS costs, higher power factor, etc. Can you break down these numbers and give us some numbers to understand what is the net LCOE impact, let's say in comparison to the plain vanilla multicrystalline modules?
I think this one, if we look at overall the recent comparison that we make, I think from where we work with the different third parties and also some of our customers, we're just comparing between, let's say, the previous generation of mono PERC at 450 watt, when we compare to maybe a 550 to 600 watt module. So overall, I mean, in terms of the BOS cost, we are seeing between at least a 5 to 7% reduction. So at the LCOE side, probably when we're looking at maybe about 2 to 5%, depending on the different scenarios and assumption. So I think maybe for India market itself, there still need a little bit of time to fine tune the design and the calculation, but we do expect that overall the general savings should be quite consistent even for India and compared to the other countries.
So were these numbers for monofacial modules or bifacial modules? The numbers that you gave us just now.
It's on the monofacial versus the bifacial.
Right. Okay. Thank you, Lim. I will come to you, Andrew, now. I think because bifacial modules seem to be becoming quite common, and the the trend really seems to be to deploy these modules together with trackers. Now, I think Indian experience with trackers has been quite mixed. Indian developers have not really, at least in our view, taken to trackers for various reasons, including whether it is high capital cost, high operating cost, concerns around maintenance, etc. Do you think, are you seeing that beginning to change with increasing deployment of bifacial modules? And what are the advancements in tracker technologies which help make a case for lower LCOE?
Yeah, thanks, Vinay. And it's my privilege to be part of this panel, and what a wonderful discussion point. It's super excited to be part of this Indian market. There's so much going on. You know, I was reading an IEA report the other day saying India will have the highest energy demand growth of any country on the planet over the next 20 years. And there'll be, you know, to reach that demand, we'll have to unlock this wall of capital of about $500 billion by the end of the decade. So, you know, for someone that's been in the solar industry for 14 years, you know, these bid prices were things that we could only ever dream about, you know, over a decade ago. So it's a privilege to be part of this market and so much dynamism and innovation taking place. I think you are spot on with the historical take-up of trackers in the market. I think the historical impediment it was a bit of a false start for trackers in India a few years ago. There was I think a few gigawatts went in. Then the module price crashed and the relative proportion of the tracker cost in the system cost consequently increased. And you know, at least using monofacial modules where, you know, the tracker uplift was typically around 15% or maybe a bit more compared to fixed tilt, the premium on the capex of about 15% when trackers were used wasn't really justified by the financial returns. Now, we've seen that pivot extremely rapidly, even in the last month of last year. Many of the major IPPs and EPCs in India with a ton of inquiries for trackers and really driven by this super low bid pricing. You know, the way we see it is with this bid pricing, tracking with the combination of bifacial, you know, it can restore the improvement in yield back up to about 20 to 25% kilowatt hours per kilowatt peak more. And the flip side of that is the modules have gone up a little bit in price, trackers have continued to decline, and so now the capex premium for tracking is only around about 10% based on the modeling that we've done for India. So you know, when we plug it all into the mix, the extra yield, you know, we paint the full picture. You know, I think as you mentioned, tracking requires more land, so we consider the higher cost of land, which you know, isn't so much of an impediment in Gujarat or Rajasthan, but maybe further south in Andhra Pradesh. You know, we've modeled a range of scenarios, and even with the higher cost of land, you know, we're seeing LCOE reductions with bifacial and tracking in the order of taking a conservative approach of between 5 to 10%. You know, that's as I say, we're very conservative there. We don't assume any kind of additional yield boost through things like our intelligent tracker algorithms to maximize the bifacial pickup of the bifacial modules, putting them horizontal in heavy cloud cover and things like that. You know, we've assumed a 10% BCD on the steel, assuming it's all coming from China, as compared to fixed tilt, where we think most of the steel would come from India and not attract this 10% BCD. But you know, we're regularly seeing LCOE reductions up at around 8%, and really getting tantalizingly close to this $27 per megawatt hour that the developers submitted in these recent bids in Gujarat. So, you know, we're convinced that the economics are for trackers and bifacial really stack up now in India, and really that's manifested by this flood of inquiries that we've had to face down since the end of last year and on into February. So, you know, we think it's only a matter of time now before we start installing our first projects with Trina Tracker in India next quarter.
Right. Thank you, Andrew. I think those are, I would say, mouth-watering numbers, if I may use that phrase. Can I just quickly ask Sanjay from Renew as well as Sanjay from L&T, do you broadly agree with those numbers? I'm sure you have been gathering your own experience and testing on making your own pilots or installations, etc. 8 to 10% kind of LCOE gain. Would you broadly agree with that?
So no, not yet. We're not seeing those numbers yet. But I'll be honest, we have just installed a 10 megawatt bifacial testbed, 5 megawatt on fixed tilt and 5 megawatt on tracker. And we are commissioning that project by end of this month or first week of March. So 2-3 months down the line, we will have better numbers. But as of now, without the test bed, our estimates are you'll see a generation gain of about maybe 20 to 22%, not 25% levels, and the cost wise it doesn't stack up. So that's where we are right now. But hopefully once we have better numbers from the running plant, we'll have a better idea. Yeah.
Sure.
Yeah. So we have also done some analysis on the test beds with respect to bifacial trackers. But in India, what is happening, the albedo, still we are unable to really predict what albedo is coming and which areas are really giving that kind of albedo, which is actually available in Middle East kind of countries. So that is also a big factor. Probably the developers who have bid this 2 rupees, they are aggressive on considering the albedos also. So whether that will be achieved at right time, we do not know. We'll have to wait and see only. And probably, yes, I agree with Sanjay Varghese. Yes, there are gains in the bifacial and trackers. Again, there is one more thing which is related to the pitch, right? Because of the land scarcity in India, getting a pitch of 8 meter right now meter is a bit difficult. Right? And then if you are going with a 1P tracker, then the tracker costs will go up, right? And then 2P you'll have to go, then your wind load and other parameters also go up. So you have to see which kind of components you need to really select for arriving at the better LCOE. So we have done that. What we do is based on all the variables, right? You know that LCOE is not simply a function of cost, right? There are a lot of other design variables like tilt, angles, then pitch, and then the location. All this goes into the LCOE, and we have seen many times that sometimes 1P is superior to 2P, and few sites if you see that 2P is much more better than that. And the gains, what NPO is telling, we'll have to wait and watch. I think we'll have to see whether that gains are really coming in, right, in the coming future.
Sure. Thank you, Sanjay. So Andrew, I mean, as you can see, I think there is still a little bit of circumspection coming in from the ground, but I'm sure the technology is getting there and is improving all the time. Can you also just talk to us a little bit about what are the cost trends? Because we do hear that the costs of trackers also coming down pretty sharply, at least on a per watt peak basis. So just also explain to us a little bit more about cost as well as reliability and performance issues or improvements.
Yeah, sure. So yeah, I guess maybe just to follow on to some of the points that Sanjay made on that last point, and really entirely valid responses. We do have a range of trackers. We do have 1 portrait and 2 portrait, single row, dual row. You know, we offer solutions that cater to different site conditions, right? So you know, as we found in Australia, I'm based in Melbourne. You know, there's been so many gigawatts of utility solar here deployed over the past few years. We're quickly encountering grid constraints now, so the industry is beginning to slow somewhat here, which is why we're pivoting somewhat to India. But you know, there was such a rush where a lot of the low-hanging fruit was quickly diminished in terms of easy sites to build, you know, completely flat, good geotechnical characteristics, and good solar resource and good grid connections. So, you know, of the sites that we're asked to quote now in Australia, they're becoming increasingly more and more challenging, and I think that will soon become the case in India, where, especially in, I think, Rajasthan and maybe Andhra Pradesh, land acquisition is a key impediment or a key barrier to solar projects proceeding. So, you know, we provide different tracker solutions that cater to different site conditions. We think there's this value stacking effect from the 1 portrait to the 2 portrait, and where you use bifacial, especially on 2 portrait, this concept of 1 + 1 = more than 2, where basically the 2 portrait, the trackers are higher off the ground, and the row spacing for the same ground coverage ratio, you get double the east to west pitch or clearance. So it lets more of this diffuse irradiance come in and around and reflect off the ground and strike the underside of the module. So we definitely see an improvement in bifacial pickup with the 2 portraits. That has to be counteracted by the fact that these 2 portrait trackers, from being higher off the ground, they do incur a slightly higher wind load. So we have to use maybe slightly thicker steel gauges and sections. So the 2 portrait trackers there's usually a cost premium of about 15% over the 1 portraits. But we also see the 2 portraits as being the way to go, because there's maybe it's certainly less than 50% and maybe as low as 30% of the piles required compared to a 1 portrait or even a fixed tilt. Sites that are really challenging in terms of geotech, where you've got something that's as low as 120 piles per megawatt or less than 50% of the piles, it really turbocharges your construction cost savings and really provides a real point of risk mitigation of what is probably the greatest construction risk. And also the 2 portraits are really good for constrained sites because they're not linked east to west. And the form factor is, 1 portrait trackers, they have this really long and skinny form factor of up to 100 or 110 meters. With the 2 portraits, because there's 2 modules rather than 1, they're wider and shorter north to south. So, and they're not linked east to west, so you can pack in and fill the corners of these irregularly shaped sites more effectively and attain a higher land utilization, and that can amortize your land acquisition cost quite considerably through having a higher plant capacity and energy yield and so forth. So we 1 portrait and the 2 portrait are both entirely valid solutions, including for India. When we're asked to look at a site and evaluate it, we consider the site conditions, how constrained the land is, how variable the terrain is, because again, the 2 portraits have a slightly better slope tolerance. But you have to weigh all that with the 2 portraits being about 15 to 20% higher supply costs. So all of that can go into the mix, and we evaluate what's better from an LCOE perspective and make a recommendation for what type of tracker to use. I think the second part of your question, Vinay, was maybe about was it about the risks?
Well, it's more about performance, reliability, and warranties.
Yes. Okay. So yeah, very good question. So especially for markets where trackers are not the dominant solution, like India, we see that as a key customer barrier or objection that we've got to overcome as compared to fixed tilt systems that are static and don't move. So firstly, yes, trackers do have moving parts. Trina acquired a tracker company. We're the only module company to have done this, where we own a tracker company 100%. So all of the warranties are entirely backed by the big brother of Trina standing behind the tracker solution. The solar industry is a hard place to make money, right? But with the balance sheet of Trina and the joint most bankable brand in the industry and the balance sheet strength, we'll be around to support that asset for the entire asset lifetime, and that technology risk goes away. On the reliability side, the tracker company we acquired, I think you've got to look at the track record of the deployment. The company we acquired had done over 5 gigawatts globally over the past decade. And they had a really rigorous vendor qualification process, which means that all the critical components have a really low mean time between failure, like a fraction of 0.00 whatever percent for the motors, for the drives, for the controllers. So, and the other thing is, when we're supplying projects as part of our bundle pricing, we look at that mean time between failure rate and the size of the asset, and we ascertain the quantities of these spare parts required to deliver an uptime of 99% or more over at least the warranty period. And that can be again a key point of risk mitigation from a tracker perspective. I think finally, to close, again, through the merit of being dynamic structures that move, especially for the 2 portraits, it's super important to make sure that your tracker supplier has been rigorous and diligent in the wind tunnel approvals. Trina have partnered with the world-leading wind consultancy RWDI to perform a really extensive qualification of both of our tracker types. not just for static loading. That was where some trackers fell down, and there were some tracker failures, structural failures in the market over the past few years. That was really the problem. There is the building codes are completely inadequate to evaluate tracker structures, because they're not like buildings, right? They move and they're not static. So we've found the comprehension of these second order dynamic effects within the industry, especially over the past 3 years, understanding these flutter and resonance effects, and really testing and qualifying for those in the wind tunnel testing. So I just encourage your audience here to make sure if they are looking at trackers to assess that the tracker supplier has applied the requisite amount of rigor in the engineering qualification, like Trina have done.
Thanks, Andrew. That's very helpful. We will come back to some of these issues later on. Hari, let me come over to you now. We've heard about various improvements in module and tracker technologies. How are the inverters shaping up to keep pace with the changing module sizes and the shapes and forms, etc.? What are the improvements in the inverter technologies, and is that also a source of gain in terms of either reduction of cost or efficiencies, etc.?
Right. Thank you, firstly, Vinay and Bridge to India team for giving us this opportunity. It's a great platform where we are discussing this. Great, speakers are there from the stewards in the industry. So touching upon the inverter technology, as you already know that, now the technology is evolving and the market is moving towards the better technology, and which is, maybe, in 1 or 2 years, it will capture 30% of the market. That is the string inverters. Now, how it is compatible with the, the topic of this discussion is the levelized cost of energy, which is less than 2. Now, if I divide the inverter technology into, the whole holistic scenario, I would divide it first in the 5 R's. The first is the, the rating. Day by day, if you see the string inverter ratings, we are getting it higher. As you compare it with the module, size also. Earlier, 2 years ago or last year, we just have, the wafer size of 110 mm. Now we are having the 210 mm wafer size. So adaptability in terms of the rating, we are also adopting. Now, in terms of the adaptability, the changes which we need to have is also evolving. We don't need the components are already there. The 2 things which we need to change is the design aspect in terms of some micro components like the CT, like the protection equipments, like the sensors. And second most important thing is the MPPT controller. So that, once the, this modules will be launched of 600 watt peak or 550, we will be easily adapt to that technology. Presently, the inverters which we are having is, 250, 255. They are able to match the modules of 500, 450, which are more prominent these days. Now, coming to the second R is the rates. The rates are, it's a, they define the capex cost. So yes, we are seeing the decline in the market year-on-year basis. If you see, it is declining 3 to 5% of the reduction. And similar, we also expect that maybe, day by day, the production capacity is increasing at different level at different manufacturers. So maybe the, the economy of scale will work in this, and similar trend will continue. This year, we are also expanding. We are expanding from 5 gigawatt to 20 gigawatt. So certainly, the industry is also changing to the, bigger manufacturing basis. The third R I would consider is the, the repair, which I consider as a O&M. Now, if you talk about the operational expenditure, it accounts a most important, component in the LCOE. You talk about the equipment failure, the maintenance, the, the material logistics, which is, particularly in the Corona days, we have seen last year how much difficult it was in the logistics. Certainly the labor, which has been pointed out by the earlier speaker, the skilled as well as the unskilled labor, and of course the capacity change. So for example, you have built the the capacity plant now, maybe 100 megawatt, or maybe if I talk about the block of 8 megawatt block, you want to increase maybe after 2 years or 3 years to a certain level. So you have to see the robustness, that how you can change and how you can scalable that 8 megawatt to maybe 10 or 12 megawatts. The second thing, which is in the O&M, is the the monitoring. If you compare the earlier technologies, you have to get all the technologies separately. So maybe the string combiner boxes, or the IV curve scanners, or the PID. But now the technology which is present in the market, you are getting it in one box. The PID is there, the IV curve scanning is there, all the components which we used to get earlier separately is combined in a box. So that's again a differential thing in the technology. The fourth point would be the the robustness. Now, if I talk about the robustness, the first thing comes in the mind is the OPEX cost. The OPEX cost, as I define that, the future technology is coming up with the future-proof things. Like, you can easily replace the inverter rather than to wait for the skilled person or the skilled engineer to come at site and replace that inverter. So it's also coming. And the last point, which is the reliability, and which is the most important thing, if you talk about the the project life cycle of 25 years. Now, with the generation consistency, it is linked to the reliability. And third, you have to have some third party reliability testing reports, so that you can showcase to the, not even to the developer, but also the safeguards of the bankers or the financer, that how reliability is connected to you. So these 5 R's I would define as the it is covering the whole inverter technology part.
Thank you, Hani. That's a pretty informative and encouraging answer. Thank you. We'll come back to you. Let me move over to Sanjay from L&T. Sanjay, you heard about the developers bidding aggressively. You heard about the equipment makers, promising major gains in efficiencies and technologies, etc. But really, I think the constant complaint I hear from the contractors is, as soon as the tariffs go down, the pressure is on the contractors to reduce costs, to optimize engineering, to implement the projects in the tightest possible time frame, etc. What are the implications that you see? I mean, are you concerned that these tariffs, viable, not viable, what kind of implication, impact will they have on your business, and what does it mean for project engineering and construction?
Before I get into that, I am in sync with what Sanjay Varghese was talking about, the aggressive cost assumptions which the bidders have taken for achieving this 2 rupees tariff, right? So that are the many possible assumptions, and probably a lot of risk factors, whether they have factored that properly, unknowns whether they have factored all the land shape, land taper risks. We do not know what has happened, or are they too aggressive or desperate to take that particular job, right? And second aspect is on the technical side. Although a lot of new technologies have come in, it is definitely reducing the BOS, no doubt about it, but at what cost? Whether it's string inverter versus central inverter, or new size of modules, or it's multi-bus bar, or even heterojunction and multi-junction modules are now coming into picture, but at what cost? That when you see that, it is again impacting the LCOE, right? When you do all these combinations, we find that in one of the projects we have seen that 490 watt peak module is making more sense than 540 watt peak modules, right? So it comes that way. And then ultimately, yes, you rightly said that the pressure comes on the EPC contractor, and that's the reason why a company like us or a big companies will pitch in, and we'll have to move away from the conventional way of execution. Ultimately, in larger projects where it is 300 megawatt or 600 megawatt, it's ultimately the speed and the scale, right? We'll have to look into possible executions using mechanization, automation, or using digital solutions, so that we try to bring down some cost and then bring value to that LCOE. So there are a lot of initiatives which we are doing in terms of aerial intelligence, in terms of automated augering, in terms of project monitoring, intra-site logistics. We have taken a lot of initiatives in that way, and then these are definitely adding value. And if you see the numbers, what we are putting right now is far more aggressive, and it definitely is making sense, right? And then a lot of thing goes into the engineering aspect, selecting the right components, right, and then calculating the losses, locating the pieces or the fundamental elements inside the plant. That also makes a lot of difference. That gives that incremental 0.5% or 0.6% on the LCOE. So definitely the pressure is on us as a EPC contract.
And do you think there's always been this fear that low tariffs are leading to poor quality project installations in India? Is that still the case, or is there enough experience, enough, let's say, credibility, because there are larger developers backed by very strong investors, international investors? Is there still a risk of quality being compromised, poor, cheaper components being chosen, etc.? Leading to a shorter life or lower uptime, etc.?
That definitely, what happens is once the cost pressure comes, there is a lot of pressure on optimization of design, right? And if you see after modules, the next big element is MMS, right? So a lot of pressure comes on that we have to achieve a sub 12 ton, or sub 13 ton, or sub 19 ton. That kind of pressure comes on. And then the foundations, of course, there are also a lot of compromises, the factor of safety, all that starts pitching in. And then the selection of AC equipments, the losses, the other parameters, all this naturally, everybody tries to cut corners, and it's very difficult to stay within that pressure premises, you can say.
Right.
So of late we have seen that yes, there are the quality issues. Even the clients are very much educated, and they don't allow this to easily happen. They are willing to spend that extra money to ensure that the asset of the or the life of the asset stays intact. And most of the developers now is not that they want to just build and then sell it off, right? They are all like Sanjay Varghese is smiling over that. They are looking at owning the assets for at least 25-30 years, right?
Yeah, it's very difficult to get away with cutting quality nowadays. Industry is now more than 10 years old in India. The lenders, independent engineers, and all of them are well educated now, so they understand quality. I mean, so it's not easy to cut corners and get away. And as Sanjay mentioned, you're building plants to last 25 years, and so if you're looking to own them for 25 years, obviously you need to ensure the quality is good. Yeah. So that's not one area where I don't think any of the major developers are sacrificing that.
Yeah. I'm sure that is music to Zia's ears. Zia, you've been listening very patiently. So just bring us the perspective of bankability and tariffs. What do you make of the low tariffs? What does IFC? I don't know what is the lowest tariff that IFC has banked so far. What would be your main due diligence items, or things that you would look into when you are, let's say, trying to finance a Tour-B project, maybe 1 year down the line?
Sure. Thank you so much for that, Vinay, and thank you for inviting me and IFC to be part of this conference. I think it's a very interesting time because IFC was one of the early movers into the solar space in India. And I personally remember, having a discussion when tariffs were in double digits, 9 and 11, which seems like a very far cry from the 2 rupee tariff that we are at today. But it just shows you, and I don't mean to date myself, but in the span of a couple of years, like less than a decade or so, or around a decade, how things have drastically changed for the Indian solar sector. At that point of time, if you had talked about a 2 rupee tariff, people would have sort of laughed you out of the room when we were discussing the viability of an 8 rupee tariff or a 9 rupee tariff. And I can see Sanjay sir is smiling and nodding his head in agreement with me, so he remembers some of those times. But in terms of whether a 2 rupee tariff is bankable or no, Vinay, I would like to push back and say, like, in isolation, the bank tariff only depends on how good the cost components are, how good is the rate of financing. So you can't per se just say that a 2 rupee tariff is not bankable and that, it should be like 250 or 260. I don't think, there's an arbitrary line in the sand that we can draw and say that below this level, it doesn't make sense. I think one of the things I would really like to point out is when we're looking at tariffs in India is the reason, and I think someone had mentioned this earlier, is the reason why there is so much interest in India despite the compression on returns. You're seeing new players coming into the market despite, developer returns falling significantly, and you need to keep that macro, 1,000-foot landscape in view when we are looking at tariffs. So that is sort of my first question. I realize that I haven't answered your question as to what is the lowest tariff that IFC has financed, but that is which we have actually approved and gotten through our system is a 2 rupee 50 paisa tariff, which was one of the earlier SECI ISTS auctions. Right now, we are looking at projects that are in the range of, I want to say 237 to 243. I think the new low of like 2, the developers are still working on their financing and haven't really approached us. So that's why we're still at this 237, 243 sort of number. With regard to what we look at in our diligence, and I think the one thing that we have learned after being in this market for more than 10 years is partner, and it really depends on who the developer is. I think Sanjay and Sanjay both remarked about how good developers who want to hold these assets for the longer term are not going to cut corners. And IFC fundamentally believes that, and therefore in the choice of our partner, we're very careful with the sponsors or the developers who we work with. We feel like, that's like the end all and be all of diligence as far as we go. Not only for the construction phase, Vinay, because for us the construction is important, but given that we are doing, loans that are 20 years, we want to make sure that our partner is going to support us over the course of the 20 years. And we've been fortunate to work with partners who have supported us, when there have been ups and downs. The Indian solar market is not one for the faint-hearted. Every day states come out with different regimes. There is pushback. There is regulatory change. There is nothing that is certain in this market. There's discount receivable situations. So in that sense, you have to, be with the right partner. And I think we've been fortunate in that aspect.
Thank you, Zia. And just on that point, I mean, can you also just talk a little bit about what have been the improvements in the financing terms over the last 2 to 3 years in particular? People are talking about the modules have improved, trackers have improved, inverters have improved, but so have the financing terms. I think the cost of capital, even on the debt side, continues to come down. So if you can just give us a little, explain what has happened to the financing structure and how that may be helping, at least to contribute for some of this tariff reduction.
Sure. So with regard to the financing terms, I can maybe break this up into two: what I have seen in the market, and then what IFC does, because I think IFC has been one of those institutions which has rigidly stuck to what we call our structuring guidelines. For us, that is sort of cast in stone, and I think that's also one of the reasons why our projects that we finance, we believe are a bit more robust. So with regard to the market, what we have seen is rates, as you know, Vinay, are at an all-time low right now. And in that sense, it is amazing as to what levels of financing you can get. And if I, sort of look at what's available in the Indian market today, we're looking at like around 8.5% to 9% from what I understand on greenfield projects, and that is relatively very low. And if you think about the and if you think of operational projects, you're getting like somewhere in the range of 50 to 75 basis points lower. I don't think any sort of greenfield project at this rate would have ever been contemplated in the past for getting like new financing. I think that's the one sort of key takeaway. The other innovation that is being made in the financing space, I would definitely think, is access to the capital markets, which hasn't been there in the past. And players such as Renew, as well as Semcorp, and the larger players actually raised bonds, both international bonds as well as domestic bonds, which has then opened up exposure limits at banks which had sort of constrained them. So I think the innovation in the capital markets has been something which has definitely impacted financing terms, especially when you are looking at refinancing of operational projects. And I think that's the one area where developers also are the most aggressive.
Sure. And what about the tenors, Zia? What is the longest debt financing that you would consider in today's market?
Sure. So, Vinay, I think tenors have now been in the 20-year range for a while. I haven't personally seen anyone go much beyond 20. The conventional wisdom is that, the projects have a 25-year PPA and you need a couple of years on the tail. So from what I have seen, you might have the 21, but pretty much they've been in the 20 range in terms of tenor, and have been there now for like a few years.
Yeah. Thank you, Zia. So I think we heard from different stakeholders, different participants in the industry, and I really want to now come to what I think there is a vision or a picture that the developers and the contractors build when they're bidding for a project or when they're even building and financing a project, as against what happens in real practice. From my limited experience, whatever we have seen is that typically in practice the actual CUF that the projects get is lower than what is built in the base case. There are, like Zia you mentioned, there are various regulatory pressures, cost pressures, site access pressures maybe, or other things. So, let's kind of try to understand how realistic is the base case that people are building today, and what are the various challenges that could turn out in future, and is that a source of concern at all, or is that fairly manageable given the experience of the industry? So again, Sanjay from Renew, I'll start with you, move over to Sanjay from LNT, and then other participants. I hope my question is clear, Sanjay.
Your question was more about PLFs, I assume, right? During the operating period.
PLFs and actual experience, both in terms of revenues as well as costs.
So cost is not a problem generally in whatever trajectory we project in terms of reduction module prices or reduction BOS. We've been able to achieve that. So we now had a problem of meeting our capex targets. Operations during operations period, there might be localized issues related to, like last year in the south of India, there were rains after monsoon season, and there were heavy floods, for example, in Karnataka, which happened in November and December. So we had lower generation than what we had projected in those months, but overall, I don't think even a bad year we have been off by more than 3% from what our budgets were. And I think the way to tackle that is to have a diversified portfolio. So if you have projects across the country, across different states, then you're taking care of that risk well. But generally in solar, I guess the risk of generation being lower than projections is pretty low. Yeah. Okay. I mean, we get pretty reasonably accurate estimates here.
Yeah, as far as my experience goes in judging on the performance, right? The PR or the CUF. So we have seen that in whatever projects we have executed so far, whatever commitment we have done pre-contract or pre-award, that is what we have held till the handing over of that particular plant to the end user. We have never faced this problem of non-performing in terms of CUF or PR. We have always ensured that the guaranteed PR is always achieved. And primarily the design of the plant, the selection of components is very important to see that whatever we guarantee in terms of generation, we achieve that.
Yeah.
Vinay, if I may jump in and just add some color, what we've seen is not necessarily. PLFs not being achieved, there's a little bit nuance around it. I think developers are slightly more aggressive as to when the PR will be achieved. So they assume that it's from day one itself. And what we have seen is that there's typically a 6 to 9 month stabilization program. And I think, it's that aspect where there's a slight bit of discrepancy. But I would say that, what actually has tripped up projects in reality is been with transmission. Now, people are much more aggressive with when the transmission lines are going to be built, when will they get connectivity, and when will they start evacuating. And I think that has been, that and land acquisition has sort of been the key challenges that we've seen. Even in solar parks where land acquisition is to be done by the solar park authority or the state, in fact, it's those sort of services along with the common infrastructure, which has, in my opinion, resulted in projects being delayed.
Thank you, Zia. And what about the construction risk itself? Obviously, we are all banking upon costs continuing to fall down, but we also see a fair bit of volatility in the short run. I think as far as we can see, module, inverter, POS, all these costs are going up. And given that these projects have to be implemented in a fairly short, restricted period of time with not much flexibility, is that risk given increasing over a period of time, given that the tariffs continue to come down, further and further? Open to everybody, Lim, Andrew, is that a concern for you that in the international markets the costs are rising, whereas the developers are expecting lower prices because of the tariffs going down? How do you meet the expectations on prices and timely installation?
Yeah, I think that's a quite difficult scenario, which we are actually going through now, especially look at the price fluctuation that has been happening for the past, I would say, at least 2 to 3 quarters. I think there has been quite a significant impact to many of our customers and to many developers in the industry. So I think going forward, I can't say that we are out of the woods yet. It seems like in terms of the whole supply chain, the price fluctuation, there is still a certain degree of uncertainty inside. So everyone is working very hard trying to see what balance point we can get to be able to offer a cost comparative component at the same time to also meet the market expectation on this lowering tariff. But I think we can't say for sure what is exactly really going to happen. Yeah, so I would say let's see how things go.
Sure.
Maybe from a tracker perspective, we're seeing tracking regularly attaining generically, single axis trackers. The technologies evolve where you can be reasonably sure of attaining a high 80% performance ratio now, and capacity factors are approaching 30%. I think the key is, when you're partnering with any technology provider, the design services they're providing, very often they'll give you an idea of the yield to make sure the solar resource file used in that energy simulation is from a bankable or a reputable source with high probability. I think we touched upon this before, partnering with a technology provider that provides high quality components, low mean time between failure, that can ensure a high uptime and availability of the trackers, the inverters, the rest of the switch gear, and so forth. And then again, I touched on this earlier, and maybe bringing it from an Australian perspective, our experience in the market here, there was such a rush. The module price was in free fall. It was a highly competitive gold rush in Australia. Many of the EPC companies went in at prices where they couldn't make any money, basically, and there was some high-profile failures of EPC companies becoming or going into insolvency. Other large tier 1 EPCs, infrastructure EPCs, who could absorb the losses, but actually withdrew entirely from the solar industry and went back to building roads or bridges or whatever. And some other European solar-only EPCs who came over the hills and quoted some projects at super low prices and didn't realize how expensive it was to get stuff built in Australia and mobilize workforces and so forth over long distances, and got burned and pulled out of the market. So, you know, I think again, I'll reiterate, for construction risk, if you can go with a solution that mitigates what I believe to be the, you know, the two key construction risks, geotechnical and topography risk. You know, you don't need, trackers don't need completely flat parcels of land anymore. We can get up to 15 and in some cases 30% of slope tolerance, but you know, you need accuracy in the geotechnical surveys, in the topography surveys, and you need technology that has a high degree of tolerance to all possible site conditions, so that the EPC companies don't get burned during the construction phase.
Thanks, Andrew. Yes, Sunny, please go on.
So Vinay, even if you see the scenario, internationally, there is the increase in the logistic cost, which is shortage of the containers are there. There is what we see that at least 4 to 5% increase in the the logistic cost. The second is even the aluminum and steel is being increased from 20 to 25% bracket. So all this increase is getting accredited to the higher costs. So this would definitely add, but certainly we have to seize out this. We have to manage all this cost and we have to support. And the icing on the cake is the BCD, which has been just introduced recently. So we are also finding out the ways that how to combat all these things and support the EPC and the developers.
So I think, thanks, Honey. I think those are all very valid points. And the question really is that with tariffs getting fine-tuned to such levels, is there enough cushion in the financial models for all the risks that the project developers are assuming? There is foreign exchange currency risk. There is obviously all the equipment, commodities, duties, taxes, and other things to manage. Government for its part, of course, seems to be keen to be driving tariffs lower and lower. I would just ask you a question, Sanjay Varghese. Are you happy with the current auctions framework? Would you like, the government is, and we know that the discoms only want lower and lower tariffs, but how would you advise a procurement agency to basically balance the lower tariff expectations with risk management and high quality installations? And is that a realistic, is that even a realistic path to take, or do you think we have to live with what we have?
No, I think this is something which has worked for the last 10 years. I mean, every time the tariff falls to a new low, the market questions whether this tariff is viable or not. But same thing happened at 3 rupees, same thing happened at 244. So as I said, maybe it's a little before its time, but sooner or later we had to get there. So I don't think changing the auction framework is the requirement here. Maybe a little bit more of predictability on the quantums that are going to get auctioned out. Right. So as I said, there was a 6-month period when no auctions happened, and then suddenly these auctions came. Then the uncertainty about offtake, about evacuation. If these things can be sorted out, the risk gets managed to a large extent. And even on the cost point, which was made earlier, the longer-term trend in solar is always downwards, especially on modules, right? And on BOS, we keep saving costs because the module efficiency is going up. But you always, every 3 or 4 years, you get this small spike which happens, because suddenly demand is more than supply. I mean, the last spike that we saw was in 2017, where there was a major increase in the prices of modules. But over the long term, it comes back to the normal trend. And so if you're doing projects over a period, it sort of evens out. If you are a one-off developer doing only 1 or 2 projects, then yes, you can get caught.
Okay, so I think
what Sanjay Varghese is telling. Yes, of course. The framework is okay, but the tariff adoption and PPA signing, I think that should become faster, as Sanjay was saying that. And one more thing is predicting cost today based on what we're going to execute after 18 months. That's a bit forecasting, and how to build up that contingency we'll have to see in the cost or the financial model.
Sure. Okay, a colleague of mine is just going to put up a poll question, so please answer that, but the webinar carries on irrespective anyway. So I think, what I gather is that, Zia is saying, and so is Sanjay Varghese and others, that by and large, the risks are manageable within the portfolio approach. As long as the developers don't take the short-term route, they are in it for the long haul. They take the, they go to the reliable vendors, the reliable equipment. These are all risks which can be managed. So that in turn now, and there's a question also to that effect, raises me to two other questions. One, what is the future trajectory for solar tariffs? Are tariffs, given the various improvements planned over the next 5 to 10 years, are tariffs expected to keep coming down? And if yes, what does it do to the status of the current signed PPAs? If tariffs keep coming down, is there a risk of more tariff renegotiations, PPA cancellations, etc.? Is that risk increasing at the same time? Anybody wants to take that? Otherwise,
the first
we have seen
PPA
that happening already, right?
Okay,
yeah,
let's look at the first one first. First question first. I mean, what is the long-term trajectory for solar tariffs? I know there is nobody has a crystal mirror here, but still, what would you expect? Would you expect tariffs to keep coming down at the same rate over the next 5 years?
It will definitely come down, but I'm not sure about the same rate. Yes, but as it keeps getting lower, and the rate has to slow down. It can't go to zero, right? So yeah, it will definitely come down. Yeah.
My view is that it has bottomed out. Probably it has to go up.
You are saying it has to. Okay. Do Andrew, Lim, or Honey have anything to say on that?
I think, I'll let Lim talk more to the modules than I, but things like module technology, there's been a big breakthrough in 500 to 600 watt format, and incrementally efficiency improving every year. But there might be another step change to, multi-junction technology to really boost the efficiency and keep driving the bus cost down. From a tracker perspective, the tracker algorithms will continue to get optimized and refined over time to really continue to shave every last fraction of a cent off of the LCOE and really maximize the production. I think Sanjay touched on a point earlier that's quite close to my heart, is about automated production and installation as well. Use of robotics and so forth, and really taking out that propensity for operator failure and non-productivity in the field. People get sick, they need breaks. You can have a robot working out in the sun all day at 100% productivity. So really the automation and robotics is where I think it's at to keep driving down the EPC cost from a construction perspective.
Thanks, Andrew. Anybody else wants to take that? Okay, I think we will let's move to Q&A. There is a question which I'm getting, which is that the interstate transmission charge exemption is going to run out very soon. It lapses in June 2023, and the logical assumption would be that we don't have this pan-India ISTS tenders anymore, and auctions move to different states. And would that be a fair assumption? And if that happens, would tariffs tend to go up? Particularly also considering that, assuming that PCD on modules is implemented sometime in the next 6 months or a year, could tariffs start going up because of these two factors?
question for?
Sanjay, why don't you take that? I think you're probably the most appropriate person to answer that.
Yeah, so as and when BCD comes, yes, it will have an impact. But it'll have an impact on these 2 rupee tariffs also, because it's covered under change in law. So even you'll see those PPAs also, the tariffs going up when BCD comes in. Regarding the ISTS waiver post 2023, yes, you're right. The market will to a large extent move to intrastate, but only in those states where there's renewable potential. So there were 8 or 9 states in the country which have very good renewable potential. So in those states, we will see the auctions happening for intrastate projects, and the other states in the country which don't have much renewable potential, you will see their RP obligations still being met through ISTS projects. Only thing that you'll see probably is that ISTS will not be pure solar, because for pure solar the transmission charges could be close to 2 rupees a unit, just the transmission charges, right? And so we will see more of hybrid plus storage high CUF projects coming up on the ISTS network, and probably the pure solar will probably move to the intrastate market here.
Yeah. Thank you, Sanjay. And then there is one more question about what are the various improvements in technology when it comes to asset management and regular O&M of the projects. Is that how is that changing, and how is that contributing to more reliable operations and possibly lower tariffs? Sanjay from L&T, you want to take that? Are you happy to take that?
Yes. So O&M and asset management, probably Hani rightly touched upon monitoring, right? And if you have a monitoring solution for at the string level, probably that will definitely add value during O&M. At least the de-snagging part, you will do it effectively. That is one part. Second is in O&M, there are 2 major costs. That is security, which can be automated, or you can get into some kind of monitoring through CCTVs and other kind of intelligent systems, so that you can bring down the cost in O&M. And then of course, the cleaning part. So cleaning part also, if it is automated, probably in a long run, it will definitely add value for the asset management. I think these 3 are the major areas. And of course, your predictive maintenance and predictive spares, how are you going to manage that? That will definitely increase the uptime of the plant and definitely add value for the assets.
Okay,
Yes,
thank you,
just
Sanjay.
one there as well. I think that, we're seeing some interesting things with things like drone flights with infrared thermography. But I think Sanjay mentioned a really exciting development is predictive maintenance, right? Like they're doing on aircraft. Predicting what maintenance is required before a transformer blows up, or and mobilizing to site and addressing that before you incur any significant downtime. So yeah, I think predictive maintenance, the drone scanning, we're seeing some pretty cool stuff in the tracker space as well. We can do some cool stuff like automatic going to maximum tilt in heavy monsoon rain to get the maximum free cleaning effect on the modules, basically. And also, weather stations talking to the overall tracker controllers. If there's things like hailstorms, put in the modules again at maximum tilt to diminish any kind of module damage and micro cracking from hailstones that might damage the modules. So there's some interesting stuff going on in that field as well.
The last question that we can take is somebody's asking how have the DC AC overloading ratios, or how are they expected to change given the proposed changes in the module form factors, the use of trackers, etc. Sanjay, why don't you take that, and then maybe we'll come to Lim. Sanjay from L&T.
Okay. So ultimately it is the generation what you are going to connect at AC levels, right? You'll have to look at a lot of factors like inverter clipping, and of course whether you're using trackers or you're using a east-west kind of fixed tilt, or you're going south facing. Based on that, you can take a call on the AC/DC ratio rather than simply going at 1.5 or 1.4, right? There are a lot of variables which can be easily controlled, and it can be definitely see that the maximum generation can be done using the same you can say boundary limits, right?
But today 50% has very much kind of become the norm, at least in Rajasthan and Gujarat. Is that expected to be the case going forward? Is that going to reduce, particularly given more efficient modules and possibly tracker use?
It can be, see, if you can you can also go to 1.55 and 1.6 levels also, right? So okay. I don't see unless and until your grid is actually limiting it completely, right? And then you are losing the generation, or you are providing power to the grid at free of cost, right? So you'll have to see how you can flatten the curve, right? So whether you use you get into the tracker mode, or you can change the configuration of the modules, right? So we have seen projects, I think in somewhere in AP it is at 1.6 ratio also is that, which is allowing a little bit of compromise on the clipping.
Okay, all right. Thanks, Sanjay. Lim, is there anything you want to add to that?
Yeah, I think generally for the DC/AC ratio, yeah, like what other speakers has mentioned, 1.5, 1.6 is quite I would say the upper limit for most of the system design. So module specification combined together with inverter capabilities, I think we can easily achieve this 1.5, 1.6, which is already sufficient in the context today. So there is no really very pressing necessity to even spec up to 1.7, 1.8, which might not have that kind of economic sense at the project level.
Okay. Okay, thanks, Lim. I think we're going to close very soon. Does any of the speakers want to ask a question to anybody else? So I'll take that as a no. I think thank you very much to all the participants and all the panelists. I think it's been a very interesting session, full of insights, at least for me. I think for me the takeaways are obviously there's never a dull moment in the Indian renewable auctions. I think the market is very unpredictable and possibly will continue to remain so. Tariffs are on the way down and will possibly come down, but maybe not at the same pace as they have come down so far. But by and large, I think the feeling I get is that it is not something to be overly concerned about. There might even be a short-term correction depending upon market movements in the next few months. But basically, the industry has got enough experience, enough credibility to manage these risks, at least on a portfolio basis. So I think those are my kind of key takeaways. Thank you very much for your valuable time again. I pass over to my colleague Sangeeta to formally close the webinar.
Thank you, Vinay. And thank you, panelists, for that interesting, insightful session. And once again, thank you all to the audience who were there. We had over 400 participants with us today. So thank you for being here and listening to us throughout the session. We would also once again like to thank our sponsors, Trina Solar and Solis, for making this event successful. We will be sharing a recording of today's webinar to your registered email ID, and we will also be hosting this recording on our website at www.bridgetoindia.com. That's all from us today, and until next time, it's goodbye.